my name is Abby and welcome back to my office. Today I wanted to go over interest rates and why do they matter so much. So interest rates are essentially the cost of borrowing money or the return on investment for lending money. They are determined by many factors including bank policies, inflation, economic growth, and market demand for credit. So here's why interest rates affect almost everything in the economy. For starters, the cost of borrowing. When interest rates are low, borrowing becomes cheaper. This encourages businesses to invest in projects. This encourages individuals to buy homes or cars, and governments to undertake infrastructure projects. On the flip side, when rates are high, borrowing becomes more expensive, leading to reduced spending and investments. So for example, during COVID, interest rates were low. So what does that mean? To get a mortgage, the rates were about 2%. So that's the cost of getting your mortgage. So you're paying 2% interest on your mortgage. Now the rates are about 6 to 7%. And you can understand the difference between 2 and 7. 2% was relatively low, and 7% is relatively high. Meaning if you were to buy a house right now, you would have to pay 7% interest on your mortgage. That's why during 2020 and 2021 there was a housing boom. Everyone was buying houses because the rates were so low. Now you'll see that slowed down. People aren't really buying houses as much at the moment, and that's because the rates are high. So this also impacts savings and investing. Higher interest rates generally encourage saving because they offer a higher return on a savings account, also bonds and some other fixed investment. Conversely, lower interest rates may discourage saving as the returns are lower, leading individuals to higher risk, higher reward investments. So in the investment space, you noticed an increase of investments in 2021 and 2022 when the rates were lower, and now you're seeing a decrease in 2023 and 2024 because people want to save their money, keep it in savings account in case something happens, or that a savings account may offer a higher return than a higher risk, higher reward investment may. So this also impacts consumer spending. So interest rates influence consumer spending patterns. When rates are low, borrowing costs are low, making it more affordable for consumers to borrow money for big ticket items like houses or cars. Conversely, when rates are high, consumers may cut back on borrowing and discretionary spending like frivolous purchases like shopping, cars, or homes. Business investment. Interest rates affect the cost of capital for businesses. Lower rates reduce the cost of borrowing for expansion, research, and development, which can stimulate business investment. Conversely, higher rates can deter businesses from borrowing for investments, potentially slowing economic growth. Now we'll get back to what I was talking about earlier, the housing market. Interest rates significantly impact the housing market. Lower rates mean lower mortgage payments, which can increase affordability and stimulate demand for homes. On the flip side, higher interest rates increase the cost of borrowing money for mortgages, potentially reducing the demand for houses and also affecting property prices. Inflation. Banks often adjust interest rates to control inflation. Higher rates can help curb inflation by reducing consumer spending and investment. Lower rates can stimulate economic activity, may also fuel inflationary pressure by increasing spending and borrowing. Overall, interest rates play a crucial role in shaping economic activity by influencing borrowing, saving, investment, spending, and inflation. Changes in interest rates can have a widespread effect across various sectors of the economy and financial markets. Therefore, policymakers closely monitor and adjust interest rates to achieve specific economic objectives such as price stability, employment, and sustainable growth. So that was me explaining what an interest rate is and why it matters for the economy and for you. Hopefully now you have a better understanding of interest rates and why they impact the economy so much.